Kia ora, and welcome to the CoreLogic Property Market Update for Here Tori Koka, August 2024. The housing market downturn, which originally looked to have ended last year, has re-emerged, with values across Aotearoa falling 0.5% in July. This was the fifth monthly fall in a row, and it takes the total decline from February's mini peak to negative 2.5%. That was one finding from the latest CoreLogic Home Value Index, or HVI, our new and improved benchmark of property value change over time. The index essentially builds up the value of every property every week, using a hedonic regression model to study the underlying value of each property attribute. This includes things like bedroom count, bathroom count, land size, and floor area. The result is a comprehensive and robust series, which also has individual indices for each property type. It is more reactive to recent market changes than our previous index, identifying inflection points sooner, including the 2022 peak of the market. A big factor here is the higher weighting put on recent sales. The index also produces a median value of all property in each of the geographic groupings, allowing an easy comparison between cities and a representative figure of the typical home in each market. The nationwide median value is now $827,515, 16% below the boom time peak of $982,918 in January 2022. Although still 19% above pre-COVID levels. Focusing on the recent performance of the main centres, each recorded a fall in values in July, with Tauranga down by 0.9% and Tamaki Makaurau Auckland by 0.8%. Ōtautahi Christchurch was more stable, down by a minor 0.1%. The median value in Tamaki Makaurau Auckland is a touch under $1.1 million. It's over $925,000 in Tauranga, and it's a much more affordable $692,000 in Ōtautahi Christchurch. While the difference in recent value change isn't simply a reflection of property price points, it is a factor. This is especially true when compared with median household income in each area, and accounting for the size of typical mortgage repayments given today's interest rates. In Tamaki Makaurau Auckland, for example, it's estimated a new 80% loan-to-value mortgage would take up 58% of a typical household's income to service. In Ōtautahi Christchurch, it's still high at 50%, but that difference could go some way in explaining why some areas appear to have more constrained demand. It's simply too tough for many people to be able to afford a mortgage to be active in this market. The historical comparison also provides useful context for the broader market, with the most recent data point for Q2 showing affordability is as stretched as ever. While this effectively measures affordability for new entrants, it's relevant for existing homeowners too, especially as they've been adjusting onto higher rates. On the surface then, the latest buyer classification data, showing first home buyers holding strong, could be a bit of a surprise. But if the last 10 years has taught us anything, it's that first home buyers are a resilient bunch and will make the adjustments required to enter the market. The motivators to get in don't really change. Security of tenure, future investment, the hope of a secure retirement with reduced housing costs, and exiting the also expensive rental market. So while difficulties persist, including saving for a deposit, high interest rates, and high house prices, they seem willing to do whatever it takes to buy their own home and make the most of their available funds in KiwiSaver to do so. They're also tapping into the low deposit lending allowances at the banks and enjoying a little bit less competition from investment purchases as well. Meanwhile, owner-occupiers making their next move in the market haven't been as active lately. Increased listings on the market provides a daunting environment to enter into as a seller, especially with the demand constrained. Some may test the market, but without the strong motivation to accept any price, properties often go unsold and are delisted. Job insecurity at present is also a factor keeping people where they are. Despite these challenges, the light at the end of the tunnel does appear to be getting nearer. It's a light for homeowners which should bring respite through lower interest rates, as the Reserve Bank gains confidence that annual inflation is very close to being back within the target band of 1 to 3%. Expectations of cuts to the official cash rate have increased with every economic data release, so much so that it's now not even about when, but how many cuts and how soon. The timing and pace of those cuts will be crucial in determining how the economy recovers from an extended double-dip recession, as well as how the housing market re-emerges from the recent dead cat bounce. To stay on top of all the important macroeconomic and housing market insights, including the monthly HVI results and just released housing affordability report, follow our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, X or Facebook. Don't forget to download our latest monthly chart pack and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.